In a previous video uploaded back in late January, only a few dozen people watched to find out why Dollar General stock could rebound back up to $100 when it was trading in the low 70s. With it now over $100, we shouldn't be too surprised since they reported a strong first quarter, opening 156 new stores and achieving a net income of $392 million. Despite not repurchasing shares in the recent quarter, the company did declare a quarterly dividend of 59 cents per share. According to Chief Executive Todd Vasos, the company is well equipped to benefit when consumers feel pressured, as they tend to turn to discount chains in such situations. The current tariff landscape is expected to contribute to this trend, with Dollar General noting that tariff-related price increases could put pressure on consumer spending. As a result, the company believes it is poised to gain from this shift in consumer behavior. The company has updated its guidance for the fiscal year, expecting sales to rise 3.7% to 4.7% and same-store comparable sales to increase 1.5% to 2.5%. This forecast assumes that current tariff rates will remain in place through mid-August. Dollar General has also taken into account the potential reversion to higher tariff rates announced in early April and has plans in place to address this scenario. As a discount retailer, Dollar General is well positioned to benefit from consumers seeking affordable options in the face of economic pressure. Todd Vasos elaborated, explaining they are well positioned to succeed in a wide range of economic environments, and its results suggest that it is gaining market share from competitors. Notably, Dollar General's growth is not just driven by its core low-income customer base, but also by middle-income and wealthier Americans who are looking to save money. The company's data shows that new customers are making more trips and spending more compared to new customers from last year. This trend suggests that more Americans are tightening their belts and seeking affordable options, which could be a sign of economic strain. That's why the discount retailer's recent success could be a warning sign for the wider American economy. The current economic environment is marked by uncertainty, fueled in part by the Trump administration's trade policies, which have raised fears of higher inflation and driven down consumer sentiment to some of the lowest levels on record. Discount stores like Dollar General tend to benefit during periods of economic strain as shoppers seek out cheaper alternatives. However, Dollar General is not immune to the challenges posed by tariffs. The company imports most of its products, and it may need to raise prices or stop offering some products to mitigate the impact of tariffs. Vasos warned that consumer spending could be pressured by tariff-related price increases, and the company intends to minimize price increases as much as possible. The fact that Dollar General's primary customers who earn under $40,000 a year are already struggling financially is a concern. In March, the company noted that low-income Americans' financial condition had worsened over the last year, with more shoppers going without basic necessities. The trend of middle-class and wealthier Americans turning to discount stores like Dollar General could be a sign that the economic strain is spreading beyond low-income households. For more on crypto and stocks, follow Ascencore. Thanks for watching and have a nice day.